This video is on market prices. In the last video, we talked about the investment decision-making process and how it's important to identify mispricing in the market. Well, that leads to the next logical concept, which is, what are market prices? And today, it's really easy to access these market prices. You can go onto any financial website, you just go onto the internet, and you can find the current market price for any stock. But I think it's valuable to take a step back and really think about, where do these market prices come from? Because this understanding should influence your decision-making process. Now, when you're talking about mispricing in the market, there is this big theoretical argument that a lot of people get into on whether or not markets are efficient. To what degree can you find mispricing in the market? What I'd like to do is I'd like to set that argument aside for the moment and just talk from a practical standpoint about how these prices come about. So let's start with a very simple definition of price. What is a price? What I suggest is that the price of something is your perceived economic benefit that you're going to receive from an item or a service. And I use the example of a machine. Let's say you were to build a machine, and this machine costs you $1 million. Well, the price of that machine, if you were to go out and sell it in the market, wouldn't necessarily be $1 million. It would be based on the value that machine creates for other people, for your customers. So let's say this machine, it cost me all this money, but it actually doesn't do anything of value for anybody. Well, then the machine is worth $0. It doesn't matter how much money I spent building it. So the price is based off of the perceived economic value of something. Now, let's extend this definition of price to the example of a business. Because when you're investing and you're buying a stock, for instance, what you're doing is you're buying a piece of a business, which should be reflective of the price of that business. So if you were going to buy a business, how would you determine the price? Well, you would look at the organization and you would say, this organization is going to generate a series of future economic benefits. Every year they're going to make so much money. So if I take and forecast out these future benefits and then value those benefits back to today, that value should be my price. Well, this is where it gets really complicated, because to determine my prediction of all these future benefits, I'm making all kinds of assumptions about the future. I'm trying to predict the future and say, the economy is going to do well, the economy is going to do poorly. Whatever my assumptions about the future are going to be where I set my price today. How much am I going to be willing to pay for this item based on how much economic benefit I think I'm going to get? That's the price. So let's take this to the example of market prices. So when you pull up in the internet the price of a stock, where is that price coming from? Well, that price actually comes from the buying and selling of stock transactions. There's all these transactions going on. People are buying and selling at different prices. Well, all that activity ends up at the current price. So that number that you pull up is the result of all these transactions. Well, all these transactions, and this is it's important to realize, The transactions are based on investors, many investors all over the world, making these assumptions about the future of this organization and arriving at a price. And they're not just thinking about what they think is going to happen in the future. They've come to certain conclusions that they're so sure about that they're actually going to put down money and purchase the stock at a specific price. All right, that's a very powerful statement. And I just want people to absorb what that means, right? The current market price is what everyone in the world has arrived at by coming up with their assumptions about the future. So let's bring this back to you, because this says a great deal about your particular investment. If you come along and you say, I have identified an opportunity that I think is a good investment, you're saying you can get a good price for something. So therefore, there's some mispricing you've identified in the market, and you want to go in, you want to purchase this stock, you want to make this investment. Well, just realize what a huge statement that is. The market price is set based off of everybody's assumptions in the entire world. And you're saying you know better than everybody else, than all these other investors. That is a huge statement. And I'm not, do not misinterpret me in this video. I'm not saying you shouldn't invest in individual stocks. I'm not saying you can't identify mispricing. What I'm saying is you need to respect the gravity of the decision of investing in a stock. And just realize the arrogance of the sheer action of doing this. If you invest, you are saying you know better, you know something that everybody else in the world doesn't know. And it's based on your assumptions. And this is why assumptions are so powerful. All right, so let's recap this again. So the market price is set at a certain level, and this is based off of everybody's assumptions. And you come along and you have a different set of assumptions. So you think the price should really be down here. Well, this is a huge opportunity, because if you buy down here, actually it's the other way around. You think the stock should be valued up here. So the stock is currently undervalued. So when the stock corrects to the appropriate value, you're going to make money. All right? So this is your opportunity. But what you want to do is you want to clearly document what these assumptions are. Clearly document your understanding. So this price, there's a certain set of assumptions. All right? Figure out what those assumptions are that everybody's making. Then document your assumptions. And then you can be very clear about why you're making this investment decision. If you can't identify what those assumptions are, maybe it's not as good as an investment as you think. The other benefit is, if you can identify what the difference is, then you can know at the time you purchase the stock how much money you expect to make. So that's what I really want to get across the point when talking about market prices, is just to gain this understanding about where these prices come from and what it means when you go in and make your investments. Now, I want to give a word of warning, and just so that people realize that there is some intelligence in the market. If you come in and you think you've identified a mispricing, that there's some stock that's undervalued in comparison to the rest of its sector, sometimes there's a very good reason why it's undervalued. So just because something's undervalued, it doesn't mean it's always a good investment. Realize that there's some intelligence in the market out there, and just try and understand what the market is telling you versus what your assumptions are. And if you can identify people's assumptions, you can better identify prices and make better investments. So to recap, we started by giving a definition of price. We extended that definition to talk about what the price of a business is, and then talked about the process of how market prices come about and why that's important in investing.